All right. Today is Wednesday, the 11th of January, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's start by this. You're enjoying the meme stock mania? We're back, baby. The apes, the donkeys, the morons, we're all back. The bull market is back in charge. Or is it? More on that in a minute, but let's start by this. While the stock market is rallying based on technicals, New Year's optimism, the Fed is bluffing, Jupiter is aligning with Uranus, it doesn't matter what reason it is. The question becomes, what are the fundamentals in the economy? And hint, not good. For example, the World Bank today announced that they're making a big cut to its 2023 growth outlook, saying the globe is perilously close to a recession. And I say maybe the World Bank needs a new eye exam because we are, at least in certain places, already in a recession. We are just getting started here, baby. Take, for example, that tsunami of layoffs, and today we got more bad news. Flexport is laying off 20% of its global workforce. And again, we're just getting started here, baby. And look, folks, in this program, it is educational. I try to cover the stock market, the economy, but I also make a lot of things because it is a stressful job to be a day trader. I know when you lose a trade, it is stressful, and you come to this program, you want to laugh a little bit. You want to make a lot of things, but make no mistake, I understand the suffering that some of you are going through. And it breaks my heart when I read some of the comments and I hear that some of you are actually losing your jobs as we speak right now. I've been there before. It is a dark place to be, and all I can say is my heart goes out to you. But we have to be realistic here. We must be prepared for the worst outcome because things are getting worse as we speak. And for those who have a job right now, please don't assume that it's going to be in the bag. Assume, just to be in the safe side, that you're going to lose your job. Have you paid your credit card? Have you gotten rid of financial obligations you cannot really afford, such as the stupid BMW that you're leasing and you're paying $800 a month? Do you really need that? Are you splurging and buying shit you don't need? You gotta start preparing right now. You never know when the moment is going to arrive when you're going to hear these words. Sorry, you lost your job. And the worst thing is, nobody's going to come to you and say that. You're going to get it via an email, via text, via Zoom call if you're lucky. It is absolutely tragic. And again, I've been there before, but I cannot imagine the suffering that some of you folks are going through right now, losing your jobs. It is not fun. But unfortunately, this is the Ponzi scheme economy that we're in. They printed a tsunami of liquidity to prop up equities and real estate valuations, and the owner class, the CEOs, the oligarchs, and the likes, amidst the mania at the top of the market, they got rid of their portfolio. They sold, they cashed out, they dumped their stocks, they dumped their real estate portfolio, they dumped at the top. And who pays the price to fix this inflation? The answer is, unfortunately, once again, the average Joe and Jane. And then what happens? When people lose their jobs, assets valuations get crushed. Those same people who cashed out at the top, they scoop them up at a cheaper price, and they centralize their power and their grip on the economy even further. Until, of course, the revolution happens and everything falls apart. But until then, this is the economy that we got. And now the most important and immediate piece of macro data that we're waiting for is the CPI inflation, which is coming out in the morning. And the assumption right now in Wall Street and in the market is that inflation is going to go down, and higher we go in the stock market. The rally goes on. The party goes on. And who cares about the Fed? They can scream and bark all they want. We're going to fight the Fed, or we're going to win. Until reality hits, of course. And JP Morgan now expects that stocks will plunge 3% in a single day if December CPIs come out hotter than expectations. So the question becomes, is it going to be hotter or cooler than expectations? Well, if I knew, I wouldn't be here. I'd be hiding in a bunker, being busy becoming the richest man in the world. But all what I can do right now is look at the data and the leading indicators and come up with a conclusion. So let's do that, and here it is. In focus tonight. Inflation shocker. 1 in 4 Americans are unable to pay their utility bills. The strong consumer, you say. The booming economy, you say. Inflation is dying, you say. Is it really? You see, in a typical CPI report, we get different categories from food to energy, utilities, vehicles, medical care services, etc., etc. So let's look at some of these categories and see what the leading indicators say. To begin with, the only leading indicator that we got is the Adobe Digital Price Index, which measures online prices. It's already out, and it says that in December, year-over-year, inflation went down by 1.6%. Now notice the trend here. It was supposed to go down further than the reading in November, but it actually perked up higher. And I see this as a warning signal here. When we look at the different categories in the DPI, the Digital Price Index by Adobe, more categories went higher month over month than they went down. Now, the overall reading went down because flour prices went down by 8%. And I'm not talking about flour prices as the flour that you eat. We're talking about actual flowers that you give to somebody who's perhaps dear to you, such as your wife, your mother, or your mistress. Yet when we look at electronics, personal care products, office supplies, jewelry, books, furniture, are you guys watching furniture prices? Absolute insanity. All went higher in price month over month, along with the most important grocery, drugs, tools, appliances, computers, sporting goods. What went down in price? Toys. Really important, isn't it? Especially with the adults who are buying toys now. What a stupid generation. But anyways, home garden down, pet products down. Maybe your dogs and your cats are happy for now. And then we got medical equipments. That's manipulated, of course, and that's why it's down. And then apparel down by about a little over 1.5%. So you tell me, looking at this leading indicator, you think the CPI will be up month over month or down month over month? Maybe because of flour prices, CPI is going to go down. Wow, inflation is dissipating. But you look at the most important categories, all going higher in price. I don't see this as a good leading indicator, but we will look at each category one by one. We have some good news, we have some bad news. Let's look at the good news first. We know that one of the most stubborn parts of inflation is food inflation. You go to the grocery store, it is absolutely shocking, the prices that we're paying right now. Yet perhaps a good leading indicator, Conagra CEO says that food inflation is starting to moderate. And when we look at the DPI by Adobe for grocery prices, we can see that it is indeed moderating. But make no mistake, food inflation remains way, way too high. And if it continues to stick here, it will be absolutely damaging to the economy because the consumer has to spend more. And when they spend more at the grocery store, all of that extra disposable income is not going out to stimulate the economy. They're not going out to dine at restaurants. They're not going out to bars. They're not buying goods. They're not spending on services because they have to spend more at the grocery store. That causes stagnation in the economy and eventually leads to a recession. Another piece of good news, not the recession. We talked about food inflation moderating. That is the key word, moderating. We also have used cars prices. That is going down big. Matter of fact, according to the Manheim Index, last month's used cars prices went down by the most in history. Now here's the problem. All in all, prices remain elevated. And again, is this really a good piece of data or not? Used cars prices are not going down because all of a sudden we have supply coming. Used cars prices are not going down because new car prices are going down and the consumer is buying new versus used. Used cars prices are going down because the consumer can no longer afford to pay these prices. The consumer is getting annihilated out there. And I'll show you that. I'll show you the evidence in a minute. So when we look at these pieces of data, if you get the CPI tomorrow and it comes out down and you see a jubilee in the stock market, make no mistake. Why is inflation going down in these major categories? Used cars, appliances, the big ticket purchases. The answer is because we have a recession in the economy and the consumer no longer have the disposable income to spend. Anyways, another good piece of data is gasoline prices at the pump. As we can see from the EIA, the average in November was $3.68 per gallon at the pump. In December, it went down to $3.2 at the pump. So maybe if you live in Texas, but in California, the most populous state in the country, yeah, you're not going to see 3.2. But anyways, that's the good news. Now let's talk about the bad news. And the majority of the bad news comes once again from California. This is absolutely shocking, ladies and gentlemen. The headline from the LA Times, why natural gas prices and bills are soaring in Southern California. It's going to absolutely shock the consumer. Now, you might say, Maverick, but natural gas prices are dropping like a rock. What are you talking about here? Here's what I'm talking about. Natural gas prices in California up by 300% year on year. Once again, up by 300% year on year. Absolutely shocking. Why is this happening? Southern California Gas Company and San Diego Gas and Electric have issued stark warning to consumers that their January natural gas bills could double, citing factors for historically high wholesale costs that include sinking inventories, supply constraints, and a cold start to the winter that has soaked the West Coast. But in many other parts in the country, natural gas futures prices have plunged, with traders Friday seeing a 17-month low at the Henry Hub, a Louisiana natural gas pipeline that serves as the benchmark for North American natural gas market. The New York, who cares? Anyways, you know the deal. We look at it every single day. The Henry Hub, it is crashing. But somehow, natural gas prices in California are skyrocketing. It is the exact opposite of what's happening in California today, said Robert Yauger, who's the managing director and energy futures strategist based in New Jersey at investment firm Mizuho Securities. Why is this happening in California? The answer is how bad the dictator that we have, King Kim Jong-un Newsom, whose insane policies ruined this state. I make no mistake, I'm not naive. I know that California always had problems. But folks, it is absolute disaster here. The homelessness all over the place. The crumbling infrastructure all over the place. Look at what's going on right now with the storm. What do you think will happen when the big one hits? I'm talking about the big earthquake. You think anything is going to hold? Any of our infrastructure is going to hold? Crime all over the place? Inflation? Absolute insanity? Makes no sense at all. Prices across the country going down. In California, they're going up. To my fellow Californians, are you happy with what's going on? How long are we going to pretend that this is okay? How long are we going to watch this man destroy this state day by day, minute by minute, and continue to vote for him over and over again? What a bunch of morons. But on top of that, it's about to get even worse. The federal government, along with the governments of California and New York, they're now looking into banning gas stoves. Now, if you're not familiar, all in all, across the country, gas stoves are more efficient and they cost less. Electric gas stoves cost more. So this is inflationary. But leave it to these lunatics who have absolutely no logic whatsoever. They want to ban regular vehicles. They want to ban gas stoves. All in the name of saving the planet. And they want to do this transition abruptly. And the question becomes, where are the EVs? Where are the affordable EVs? Where are the affordable electric stoves? The answer is they're nowhere to be found. You take the abundant supply of regular cars, of gas stoves, you ban them, and you leave all of these consumers competing on whatever supply left for EVs and electric stoves. That's inflationary. Supply is down, demand high, prices go higher. These people are absolute lunatics. How about we do a gradual transition? Get the supply in line, get an abundant supply in line, and then gradually transition. That way you don't cause inflation. But again, your beloved politicians have no logic at all. And when it rains, it pours in California. The drought, which is supposed to be over right now, but we're wasting all of that water back in the ocean. Millions of Californians are now struggling to pay the bills for water because water bills sky high. And folks, the tragedy in utility bills skyrocketing across the country, not just in California, leaving consumers behind. 1 in 4 Americans, 25% of the population, are now unable to pay their energy bills according to the U.S. Census. Again, 1 in 4 Americans, they're unable to pay their utility bills. So when you hear all of this Fugazi data, all of this bullshit data about, oh, the consumer is so strong, consumer spending is robust. You know what's robust? It's your ass. Tell me how the consumer is robust when 1 in 4 Americans are behind in their utility bills. So when you get the data about, oh, Q4 GDP by the Atlanta Fed shows that consumer spending is healthy and it is pushing GDP higher. Is it really healthy, or is the consumer paying more for goods and services? So the GDP that you see right now, that's fake. Of course, consumer spending is moving higher because we're paying more, not because we're buying more, not because we have more disposable income in our pockets. So again, when it comes to the CPI, utilities, electricity bills, I don't see this as a good spot. This will be a bad one. Another bad one would be airfare ticket prices, I should say. In the month of December, there's no doubt in my mind it would be absolute embarrassment if the Bureau cooks this data and shows us that airfare ticket prices went down in December. Nobody's going to buy this. We all know what happened with the Southwest fiasco, canceling thousands of flights, leaving millions stranded at airports. And all of these folks had to compete on whatever supply left of tickets by other airlines to go back home. For me, for example, Southwest canceled my flight. I paid $800 for a flight by Frontier Airlines. And again, I'm not complaining here. I know other folks who paid $3,000 for a ticket to go back home. Unbelievable. And today you might have heard the news that all flights in the US were grounded because of an FAA system outage. This is the richest country in the world. We have a crumbling infrastructure, yet we're sending $100 billion plus to the strip club in Ukraine. What's going on here? All of these delays, all of these cancellations, these are inflationary in nature because folks are stranded. They have to book flights again, and the prices are going higher and higher and higher. So in my opinion, in tomorrow's CPI, airfare ticket prices should go higher month over month by a lot, and that could tilt the overall CPI higher. So watch out for this category. And the conclusion is, according to JP Morgan's trading desk, they see that the market is going to rally because the probability for the CPI to come out below expectations is the highest. Again, JP Morgan has a good track record when it comes to this, but who knows? According to the Landromat, they say if the CPI comes out below 6.4%, the probability of that is 20%. The S&P will go higher by 3 to 3.5%. But the more probable outcome is the CPI would be between 6.4 to 6.6%. The odds for that stand at 65%, and the S&P 500 reaction will be up by 1.5 to 2%. However, if the CPI comes out with a shocker above 6.6% year on year, the probability according to the Landromat is 15%. The S&P will go down 2.5 to 3%. Now, this is what the fundamentals say, according to the leading indicators of the fundamentals, category by category. We have some good news, we have some bad news. In my opinion, I think the CPI could be a little higher than expectations. But again, it depends on shelter inflation. If that comes out down, if the cooks show us a tame reading for that, the CPI all in all could come down. Now, this is what the fundamentals say. Now, stick around till the end of the video because we're going to cover the charts. And the charts, some charts say that the CPI will be hotter than expectations, but a lot of them say that the CPI will be cooler than expectations. We'll cover that in the charts analysis and make a conclusive slide. So stick around for that. But for now, I'm going to move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average up big by 268.91 points, or a gain of 0.8%. The Nasdaq up by 189.04 points, or a gain of 1.76%. The S&P in the green by 50.36 points, or a gain of 1.28%. Now, when we look at the performance of the sectors today, all in the green, we're not going to shame anybody here. Yet at number 1, capturing the gold medal, real estate, number 2 for the silver, cyclicals, number 3 for the bronze, communication services. And the laggards of the day, once again, defensives and healthcare, which I still see the opportunity. The timing, that's a different conversation. But as an investor, you should look at defensives and healthcare going down and lagging with excitement because you're writing down names, you're putting some cash on the sidelines. When this stupidity washes away, when this beginning of the year rally is done, you're going to buy some stocks in healthcare and defensives. When we look at the breadth, and this is bad news for the bulls, the NYSE 75% advancing versus 23% declining. The Nasdaq 65% advancing versus 32% declining. Why do I say that this is bad news for the bulls? Because they're front loading a lot of these gains pre-CPI. They're heading into the reading with an exaggerated reading to the upside, and that makes the risk to the downside. That even if the CPI comes out maybe not as hot as we expect, maybe it comes out a little hotter than expectations, we could see an oversized reaction to the downside, and it pushes the bar higher. When we look at JP Morgan's predictions, for example, if 6.4 would have initially made the S&P react by moving higher by 2.5%, that's not going to happen anymore, because the market is now pricing in 6.2% to move that much. 6.4, maybe it's going to move the S&P by, I don't know, half a percentage point higher, because the expectations are now that the CPI will be down by a lot as the market continues to rally ahead of the reading. Anyhow, moving on to commodities, and again, when you say peak inflation, look at what's going on in energy commodities. As the dollar continues to move down and perhaps consolidate for now, awaiting the CPI, we see commodities moving higher. Massive gains today for the WTI and Brent, all scoring gains worth about 3.5% for the day. Likewise, gasoline, RBOB futures, scoring massive gains worth about 4.75%. Heating oil in the green by 1.75%. Natural gas also up by almost 1.5%. When it comes to softs, the collapse in coffee prices continues, down yet another a little over 5.25%. It was also a muted downside day for cotton futures, a muted upside day for OJ futures, flattish day for sugar futures, but the winners, once again cocoa and lumber up by around 1.7% for the day. When it comes to metals, again, gold, silver, platinum, palladium, all following what the dollar is doing. Dollar is flat, they're flat too. But copper continues to rally in a mind of its own, up yet another about 2.5% for the day. Because again, copper has two tailwinds. Number one, the dollar moving down, but also this China reopening crap pushing copper higher. So here's the thing. If the CPI comes out hotter than expectations and the dollar pops, the majority of the declines in metals will be in copper. It will experience a big flush down. Now, when it comes to meats, flattish across the board, be it lean hogs futures, once again, the laggard of the day, losing a little over 0.7%. When it comes to grains, once again, leading the gains, oats futures, with another upside day worth about 3%. Then we have a rebound for wheat, a little over 1%. Soybeans, soybean meal also in the green. Then we have some declines here in soybean oil futures, down almost 1% for the day, along with canola and rough rice, all down by a little over 1% today. Moving on to the big casino, the options market, what do we see here? The Three Musketeers, once again, the hottest three tables for the day. Although we have Amazon at number 2, not Apple. We take them one by one, and at number 1, Tesla, the souffle, with around 3 million contracts traded today, so the volume is moving higher again. Not a good sign for the bulls. It could be due to hedging before the CPI, we'll see, but they're buying more puts again. Another bad sign. But it could be hedging, and therefore it did not jump into conclusions today by shorting the SPY, shorting the Qs big time. I'm actually standing on the sidelines right now. Made a lot of gains in these stupid meme stocks. AMC, Bed Bath & Beyond, have my gains, waiting on the sidelines. And I will follow what the CPI feeds me, although I'm still long Tesla. In any case, the souffle at number 1 with around 3 million contracts traded today, about 57% of those were puts. And at number 2, one of the biggest winners of the day, Amazon, with a little over 2 million contracts traded today, once again, puts outweighing calls this time around by about 55%. Apple at number 3 with around 1.2 million contracts traded today, once again, puts outweighing calls this time around by about 56%. On to the unusual activities that took place in the options market today, and we start with the call spread for UNVR Univer. Now, this name has been moving higher. It has been a winner year to date and has been a winner, or let's say an outperformer last year. We have a lot of firms interested in buying the stake in this firm, in this company, I should say. Among them, of course, Apollo Management. So the stock is moving higher, and somebody sees more gains to come, but they want to play this upside via a disciplined way, and therefore they're buying some call spreads here. They bought the 35 calls and sold the 40 ones, all for the expiration date March 17th, with expectations that UNVR could move higher and gain more than 5% by then, but not more than 20%. They paid around $2 a piece for buying the 35 calls, and they received in credit about 70 cents a piece from selling the 40 calls. All in all, the entry cost is reduced to $1.30 a piece, which brings the total all the way to $2.8 million. Now, what about the ticker MGM for, you guessed it, MGM? Somebody sees more downside coming for this name. They bought the 36 puts for the expiration date, February 10th, with expectations that MGM could go down and lose more than 6.5% of its value by then. They paid around $1 a piece to enter this trade, all in all, spending around $1.5 million. And then what about the winner for the day, Amazon? Somebody sees more gains to come. Lay off optimism, baby. And they bought the 103 calls for the expiration date, January 27, with expectations that Amazon could move higher and gain more than 8% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $700,000. Last but not least, what about TGTX? This is for TG Therapeutics, a big loser last year, but it has been moving higher impulsively this year on rumors that perhaps a bigger pharmaceutical company buying it, who knows. For now, we're seeing a short squeeze and somebody's playing along. They bought the 16 calls for the expiration date, February 17th, with expectations that TGTX could move higher and score gains north of 22% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $700,000. Moving on to the heat map analysis, what do we see here? Once again, the theme continues. Buy the losers and dump the winners of last year. Again, not a sustainable theme, but when we talk about the losers of last year, we have the big caps Apple, Microsoft, Google, Amazon, Tesla all moving higher. We have names such as GE continues to be an outperformer for the year. Yet today, the difference is we're seeing some dip buying in the losers so far this year, the winners of last year. These names happen to be in real estate, for example. Some of the big pharma names, such as Eli Lilly, that was up today. Likewise, some of the consumer defensives are holding ground and rebounding today. Of course, when we have a risk-on theme, nobody wants the defensives, the safe stocks, the recession kind of stocks. So we see names such as the ticker DJ for Dollar General, that's down today. VZ, Verizon, that's down today. Some of the big pharma names, AbbVie, also down today. Now, if the CPI comes out of this shocker to the upside, we will see the rotation of the rotation from the winners of this year, losers of last year, to the losers of this year so far, winners of last year. We're talking about the defense contractors. We're talking about the defensives. We're talking about utilities. We're talking about the big pharma names, so keep an eye on that. Now let's talk about some corporate news, and we start with the fiasco, or shall we say the family drama at the WWE, because Vince McMahon, who knows what's going on with Vince these days. If you told me 10 years ago, I would say Vince will never, ever sell the company. But now Vince makes a comeback, takes out certain executives, revenge of course. And now the rumors floating around he's going to sell the company to Saudi Arabia. And of course, this is causing an outrage and perhaps a rebellion within his own family because his daughter, Stephanie McMahon, stepped aside. She resigned from the company. And now it becomes Vince versus Stephanie once again. Look, I don't know what's going to happen here, but I took the opportunity today in trading WWE. It popped significantly higher in the morning, but it became really, really overbought. And these rumors about Vince McMahon selling the company to Saudi Arabia, A, is it really going to happen? B, is it going to be allowed? To begin with, will the FTC see a problem with such a buy by Saudi Arabia of the WWE? And therefore, I bought puts right away as soon as I saw the pop and the overbought conditions, and immediately the stock flushed down and I got out. In, out, hello, goodbye, always be closing. Thank you so much. Made a quick buck within about, let's say, 10 minutes. And then we have bad news for the jab companies, Pfizer and Moderna, all down for the day. Pfizer has been getting crushed year to date. We talked about Senator Bernie Sanders threatening that he's going to do nothing if they continue to keep prices higher. But we have another problem here. A, bad news from the Pentagon. The Pentagon finally buckles because we have about 8,000 soldiers who say, you know what? You're going to force us to get the jab? Goodbye. And now that we started World War III, we need all of these soldiers. So the Pentagon says, no mas. You don't want to get the jab? That's fine. And therefore, Pfizer, Moderna down. Now, B, the other bad news for these jab makers. We continue to get these news of healthy young people dropping all of a sudden, be it celebrities, be it sport players. And the rumors, the talk on social media becomes, oh, so-and-so dropped dead because of the jab. Now, I don't know if that's right or wrong. I have no data at all. But the rumors alone are adding pressure on these companies that if they want to do, the 25th booster now, they can't do that anymore because nobody wants to get them. This is bad news for these companies. But while the human beings say no more, we're not taking any more jabs, perhaps Pfizer and Moderna could rebound because now they're going to jab the queens. No, we're not talking about drag queens. We're talking about bees. We have an approval for a jab for honeybees. No comments from me. Anyways, we got bad news for Tesla the souffle because a footage of an 8-car accident in San Francisco got leaked by The Intercept. And apparently the souffle just stopped out of nowhere. Boom, slamming on the brakes. And right behind it, 8 cars get piled up. And therefore, when I'm on the road and I see a souffle, avoid. I don't want a souffle behind me. I don't want a souffle in front of me. Not on my side. When I see a souffle, I pass. Hit the accelerator, pass it, have a few cars behind you as a cover, because these things could go haywire without notice at all. Maybe it's possessed. Maybe the souffle is getting possessed. They slam on the brakes all of a sudden. Anyhow, on to the heat map for the ETFs. The tide that lifts all boats, the algorithmic tide, everything is in the green, but once again, value lagging growth. We see ETFs such as the XLP, XLU, XLV, where the value is lagging. And by the way, you could argue that financial ETFs such as the XLF, KRE are value too. You can argue that energy are value too, but these tend to be cyclicals, meaning if the economy is heading into a recession, they tend to underperform either way. So my description of value is Defensives, utilities, and healthcare, all lagging for the day. What's winning? Technology, cyclicals, and this time around, a major rebound in real estate. When it comes to commodities, we have a major rebound for natural gas, UNG, BOIL. So again, if you're going to trade these guys, always be closing. They go up big, they go down big, and then up big again. Major volatility here. Now, when it comes to the international ETFs, the talk of the town is it time to rotate out of China, out of emerging market ETFs, out of developed market ETFs, even European ETFs, in favor of Brazil ETF EWZ? Perhaps, but it is too risky because we have instability in that country. I'd rather buy individual stocks from Brazil rather than buying the entire ETFs, the good, the bad, and the ugly. Moving on to charts, and we begin with SPY, the S&P 500 30 minutes chart. What do we see here? Blasting higher, another gap higher, and perhaps completing the ABC pattern. It doesn't need to go all the way to the resistance of 398 to complete the pattern. It just needs to make a higher high, and it did today. Now the support becomes 393.16. Here's the problem for the bulls. Yes, everything for now leading to more gains to come, but look at the RSI. It is becoming overbought on the 30. What does that mean? It means that the risk is to the downside if the CPI comes out surprising to the upside. We could see a sharp pullback, perhaps all the way to closing the gap that the chart opened today. But even if that happens, does it change the outlook on the daily chart for the continuous contract for the S&P? The answer is not quite. Not until the chart loses 3,855 as support. For now, it actually has been a major win for the bulls in this chart because they got 3,960 as support. They closed the day above this number. The RSI is firming up, the MACD is firming up, but are they about to stall? Are we about to go down? Losing the support that the chart gained today, that will only happen if the CPI comes out surprising to the upside. And therefore, I'm waiting on the sidelines. This rally so far has been good. You buy calls, you close them right away, in, out, hello, goodbye. Always be closing. For now, we wait and see what happens in the aftermath of the CPI. When it comes to the Qs, 30 minutes chart, what do we see here? The problem with this chart is it finished the ABC pattern, it made a higher high, and it's now becoming overbought. So the risk becomes to the downside in the short-term charts, in this case, the 30 minutes chart, if the CPI comes out too hot. We could go down to close the gap, even go down all the way to 269.29. But even if that happens, does it change anything on the daily chart for the continuous contract? The answer is no. Until the chart loses the important number of 11,058.5, otherwise you have no shorting signal yet. Keyword, yet. For now, the RSI remains in positive divergence. The MACD continues to firm up, all indicating for more gains to come absent of an unpleasant surprise by the CPI. Now, what about the Russell 2000, the IWM 30 minutes chart? I've been riding this one higher versus the Qs and the SPY because small caps have been leading the gains in this rally. And in the small caps cohort, the trash names, the meme stocks, Bed Bath & Beyond, AMC, GameStop, although I think GameStop is in the IWN, but regardless, these names are moving the IWM higher. So if you want to ride the meme stock mania, you don't have to take a lot of risk by buying AMC, GameStop, Bed Bath & Beyond. You can do it safely by riding the IWM. I did both. I bought calls on the IWM, Bed Bath & Beyond, AMC. I closed all of them today because for now, the pattern has completed. It is making the ABC pattern all the way almost to 182.77 as the resistance. Most importantly, the IWM is becoming overbought on the RSI from a 30 minutes perspective. So again, the risk becomes in the immediate run to the downside if the CPI comes out too hot. However, we have a lot of other charts showing that perhaps the CPI will come out pleasant and we will see the rally continuing here. Among them, the dollar, at least for now. The dollar is showing a lot of weakness. Still holding above 103, the important number, but look at the RSI, look at the MACD, all losing momentum, indicating that the dollar for now is positioning itself to lose 103 in anticipation of a cooler than expected CPI. But boy, if the CPI comes out hotter than expectations, we will see a massive, massive pop in the dollar. And that will come hand in hand with a massive pullback in gold. So the rally in gold, a little too risky right now. The fact that the dollar is keeping 103 is a message within itself. It says that the dollar is not really sure. It leans toward a CPI coming out cooler than expectations. But it's still playing out the possibility that it comes out hotter than expectations, and therefore the dollar says, I'm not losing 103 until I know for sure that the CPI is cooler. And therefore, today will be the confirmation whether the rally in gold continues or not. The dollar loses 103, the rally in gold is good and solid. The dollar rebounds, keeping 103 as support. The rally in gold so far has been a fugazi, and it goes down in a big flush down. Likewise, another important chart to watch in tomorrow's activities, oil, be it US oil. In this case, we're watching UK oil, Brent. This is a weekly chart. Today was a big pop, and look at this. The RSI is improving. The MACD is improving. And if we see the dollar moving down because the CPI is cooler than expectations, it will be a double-edged sword. It is no reason for celebration, because as the dollar goes down because the CPI is cooler, quote unquote, than expectations, oil is going to pop big time. And if it does, it's going to get 85 as support, it's going to get 90 as support, and it might even get 100 as support. Keep an eye on the chart of oil. A lot of action here, folks. One chart says CPI will come out down, another one says CPI will come out up. But every chart is being tactical right now, maintaining support, maintaining resistance, waiting and waiting for the CPI. Another chart maintaining support for now, the 10-year yield. If the CPI comes out cooler than expectations, then the conclusion becomes, oh, the Fed doesn't have to be as hawkish as they're saying right now. Rates don't have to go as high as the Fed is projecting right now, and the 10-year loses support. In this case, 3.5, and we see a big flush down here. But if the CPI comes out saying, hey, not too fast, the Fed will have to raise rates higher because inflation is sticky, then we see a rebound keeping this support of 3.5. But for now, is the chart leaning one way or the other? The answer is it is leaning toward a cooler CPI than a hotter one, because it is consolidating in a bear flag pattern, waiting and waiting for the permission from the CPI to lose 3.5 as support. Likewise, the TLT is moving higher. It retested 103.5 as support. So far, so good. The RSI is improving. The MACD is improving. It is just waiting for the permission from the CPI to run a retest to the resistance at 109.5. Now, what about the VIX 4 hours chart? What do we see here? Is it a bear flag consolidation pattern? And down it goes in a retest to 20 if the CPI comes out cooler than expectations? This is certainly the setup for now. But again, folks, when the setup is favoring one way or the other, what is the surprise element? The surprise element is CPI comes out hotter than expectations. And we see a massive rebalancing here. Folks were betting the VIX will go down in the aftermath of the CPI. Now they have to scramble, and we see an oversized reaction the other way, meaning the VIX pops significantly higher and the SPY flushes down big. You see now why I'm standing on the sidelines? It could go either way. Even the charts are saying it could go either way. Look at Apple, 30 minutes chart. What do we see here? It completed, technically speaking, the ABC pattern. Doesn't have to go all the way to 134.37, but it has become really overbought on the 30 minutes chart, so the risk becomes once again to the downside. Tesla, 30 minutes chart, what do we see here? Honestly, nothing to see here. The resistance at 128.62, all what we have right now is consolidation within a range. But if we use a line chart instead, what do we see? Are we seeing a saucer bottoming formation? And if that is the case, if the CPI comes out pleasant to the market's expectations, Tesla would be a major buy. Bitcoin, daily chart, what do we see here? Yes, we have a pop today, but does it change anything at all? The answer is not really. Until the chart closes above the top of the breakdown candle, which happens to be 20,593.34. Until that happens, Bitcoin is not out of the woods, not yet. And here is the recap, folks. Which charts are saying CPI goes higher, stocks go down? Which charts are saying CPI goes down, stocks go up? For the former, the SPY 30 minutes, Qs 30 minutes, IWM 30 minutes, gold, Apple 30 minutes all say the CPI could come out hotter than expectations and we see a flush down in stocks. For the 30 minutes charts and gold, it is because they're becoming overbought in the short run. Now, for the charts saying that the CPI comes out down and stocks rally, based on that reading, we have the daily charts, the Qs, the SPY, IWM, doesn't matter, Dow Jones too. We have the dollar index also saying that because it is forming a bear flag pattern, waiting and waiting for the permission to violate the support of 103. And the same goes for oil. It is waiting and waiting for the permission by the CPI to pop higher. TLT, similar story. 10-year yield waiting to violate the support of 3.5%. The VIX is also showing a bear flag pattern, waiting and waiting the CPI to come out to move all the way down to 20. So the most important charts are saying CPI comes out down and stocks continue to rally. But the shorter run charts say watch out, the risk could be to the downside here, even if the CPI comes out tame, meaning meeting expectations. This is the risk when the market rallies ahead of the reading, that even if the CPI comes out tame, plain vanilla, stocks could go down because they're overbought in the short run, and therefore the bar becomes higher. In this case, shall we say, lower? And the reason is, what could have moved the market higher, let's say 6.5% for example, now it becomes 6.3%. Because the market already priced in the move ahead of the reading. I hope this is not confusing, folks. If it is, please ask questions in the comments. And I hate to spoil the party, but maybe we go down tomorrow either way. You know why? Because your boy Jim Cramer jinxed the rally by saying that the chart suggests the market could rally for the next couple of months. In other words, if you follow the inverse Cramer ETF, we go down big tomorrow. Anyhow, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow in case you were asleep throughout the video? We have the CPI, aka the CPI, the Consumer Price Index. And the risky part of all of this is we have a bunch of Fed zombies commenting on the CPI after it comes out. Among them, Fed President James Blaze from the St. Louis Fed. If the CPI comes out hot, Jim will come out and say, oh, rates will have to go 5% plus, maybe 6% plus. And the market is not going to like any of that. Anyhow, folks, this is all I got for you for now. Once again, thank you for listening, thank you for watching, and buckle up because I'm going to see you and talk to you again tomorrow. Take care.
Oh, see, I made Lewis a bet here. Lewis bet me that we couldn't both get rich and put you all in the poorhouse at the same time. He didn't think we could do it. I won.